That's a really good sign. I mean, it's got a very strong chart pattern. You could look at this in a few ways. It has this huge rally up. It has this big consolidation. It's trading at this 618 level, which if you remember, James, whenever something hits a 618 level and pauses, we almost always go up and see it hit the 100% measured move. So it's showing like it could go to about $154 to the upside. And that it's a very strong pattern. We've got this rally up. We got this giant, pennant formation where it's consolidating, and then it's broken out. It had a little pause, and I wouldn't be surprised if we see it eventually continue to go higher. So I like something trading near all-time highs, leading the sector or the space versus like, Newmont, which anytime it gets up here, it just crushes your dreams and falls back down for 5 years. So you definitely want to pick the leaders, and in the high momentum plays, they're the ones that benefit the most. There's all kinds of studies that show if you're in the leading high momentum plays in the long run, you'll outperform most other strategies. And so this one's definitely leading the way. We're really at a critical tipping point here. So the stock market had a bit of a breakdown about a week and a half ago. High volume selling, a lot of things underneath the hood of the market. A lot of technicals actually broke down temporarily. And that was a sign of some weakness. And I mean, if we take a look at the trend, this is the SPY ETF. You can see here we had the early year sell-off, which, the market, the technicals told us to get out. Eventually the bounce turned into a rally, told us to get back in. And last week, the market said, hey, get out of this. Now, this is the same for the S&P 500 and the Nasdaq, the QQQ. So right now we're on the sidelines. We've locked in kind of right up near the highs. And the market is trying to tell us, trying to figure out, are we going to kick back into an uptrend and reload and be able to scale out as we hit more targets? Or is it going to actually roll over and sell off, kind of like what we saw last year? In fact, check this out, James. So I was looking at last year. The top chart is the QQQ for this year. We have this April big sell-off, the low, and we've had just the breakdown of last week. Look at 2024. We had the April low last year, and almost in the exact same time frame, we had the same type of technical breakdown, and it led to about a 15% correction down to the April lows. Now, the April lows from where we are this year are more like 25% away. So I'm not saying this is going to happen, but it's a very interesting scenario we have going on. And the market right now, this recent drift up as the market's poking to new all-time highs pretty much today, as you and I are speaking, that is kind of Magnificent Seven driven. The underlying stocks are actually very, very weak, which is what our strategy is telling us and why we have those red bars. But there's a handful of stocks keeping things going higher. So the market is on the cusp of starting another leg higher, probably Magnificent Seven driven, or it is about to roll over. And that's what we're kind of just waiting to see how that is going to happen. And that's kind of my take for the markets. Is this is the tipping point this week. Got to figure out where things are going. We're on the sidelines. Sometimes sitting on your hands is the best thing to do, and wait for a confirmed trend before you take action.
Patterns from the past offer a cautionary lens. Last year, an April recovery morphed into a sudden technical collapse, a nearly 15% pullback. Today's early year bounce mirrors that same arc, though any reversion now could be steeper, perhaps 20-25%. Meanwhile, parallels with 1998 are unsettling. New highs, low VIX, narrowing breadth, and mounting complacency suggest the makings of another steep correction, one that could rival the subtle prelude to the dot-com crisis. These historical echoes are signals, not certainties, but they demand attention.
The reality is no one knows, none of us know. It's just who has the best strategy to follow price. So once it starts to roll over, we know to step aside. And if it turns back up, who's got a strategy to clearly and as early as possible identify a new strong uptrend? And that's where most people struggle, is they don't have an exit strategy, and we just never know how far this market is going to pull back. Right? Any one of these pullbacks in the market at any given time could be like a 1 or 3 or 5%, or it could be a 55% correction that takes 10 years to recover or longer. And so that's what I focus on. Is I don't really, nobody knows what's going to happen. So we have a strategy. If it rolls over, we get out, and we make sure we're not going to be, caught holding a falling knife in this market. And if it turns back up, we get long again. And so that's the way you have to really look at these markets. And the buy the dip mentality is so strong still right now. Every dip, people are like, no, we're going to all-time highs. We're going to keep going. Don't fight the Fed, don't fight, QE and all that stuff. And, yeah, it does make sense to some regard, but eventually one of those dips is going to be the one that slaughters all the buy the dippers, and they're all going to be suffering dramatically. And so that's what I avoid, is I don't want to be, I don't want to give back half my money and get stuck in a trap where you're down so far, so much. You're like, I can't get out of this now.
But at the same time, you're missing out on a lot of the upside, because if you look at the last 5 years, anytime we had a significant pullback, it was always a buying opportunity. April is a case in point. Why not just get long and stay long?
Well, eventually, here's the thing. Who I'm focusing on and protecting I do this whole strategy for my own capital, but more or less, if you are close to retirement or retired, eventually one of these is going to be a 50+% correction that takes a decade to recover.
Markets today are a battleground between exuberance and restraint. Algorithms and AI-driven models are radiating bullish enthusiasm, while many human investors remain cautious of asymmetric risks. With inflation data looming, especially the July CPI, nerves are frayed. Certain strategists foresee corrections up to 15%, while earning strength and Fed rate cut expectations fuel optimism. Yet, as a reminder, seasonal volatility, especially in August and September, is historically elevated. Is the 6,500 level on the S&P a launching pad or a ceiling? Opinions diverge dramatically.
And yes, buying the dip will work over a 40-year window, no problem. But if you're 85, you don't have 40 years or 10 years to just give away half of your wealth, and the suffering and the worries that come with that. So if you just follow price action, you know when to get out, you know when to get back in. In fact, we got out here and we were able to buy back in at like 6% lower price. So moving in and out isn't always costly. In fact, it can not only allow us to profit from falling pricing, but then we can buy things back at a cheaper price like we did this year. So it really comes down to how nimble and how good of a strategy you have to identify these waves that roll through the market. But there's no doubt long term you can buy and hold. But the thing is, if you have wealth, you've got a good lifestyle and you're a bit older, you definitely don't want to give back half of it or more potentially, and then have 10 years of stress and strain and sleepless nights worrying, if you're going to run out of money or how long the recovery is going to take. So I have no problems moving in and out. I also have no problems sitting on cash, watching markets rally without me sometimes. That's just part of the game. I don't get FOMO. I know there's always going to be another opportunity in the markets. It'll pause and pull back and create another opportunity to get in. There's always going to be different commodities. So the mentality that most people have is they always have to be in the market. They have to make as much as they can. They feel more pain when they miss out on watching the markets move up than they do actually holding a loss. There's all kinds of studies that say FOMO is more painful than just taking a huge beating on your account. And it's true. If you can get over that and realize there's always going to be another opportunity, and the next pause or pullback will be that opportunity to reload and get back in, the markets become not that stressful. But everybody's been brainwashed to think you need to trade a lot. You always have to be in the markets. If you don't buy the dips or you don't hold it, you're going to miss out on gains. And put it this way, there's no easy way to navigate the markets. It's taken me like almost 30 years to really nail them down and become very efficient in them. Even the best still struggle. So you're going to miss on some rallies and you're going to get out of trades too early in some points, but it's just part of the game, and you just have to accept that's how it is.
Right now, the best move may be to wait. A structured price action approach, enter only on confirmed trends and exit when breakdowns occur, serves both growth seekers and capital conservatives. Without robust entry and exit rules, buy the dip enthusiasts risk being caught in violent reversals. Salvation lies in strategy, not emotion, nimble moves, timely exits, and clarity when to be in or out. For those near or in retirement, protection of capital may outweigh chasing every rally. The discipline of sitting on one's hands can be powerful.
We have, depending on your style, your time frame. So, for example, like whenever I buy physical metals, I buy them at beginnings of new cycles. I don't know if this chart will load all the way back down, but 2008, 2009 was the start of a massive super cycle. 2019 was the next one. And I believe we're going to continue to go see. I think this is still like on the move up. I think we're going to about 4,100, if not even higher for gold. I hold gold. I'm saying what I like about gold here from a more of a trader standpoint. I like this bull flag pattern. If it starts to break up, I want to jump in on it because I think there's 15 to 20+% upside as a trade. I think people should be holding gold and long term. I think it's a very good play. I mean, it's definitely popped and rallied to the upside. This is what's really interesting is we've seen gold trade sideways, but the gold miners have popped and broken out. So that is a really good sign. That's telling me that we should see physical gold follow suit and move higher. We saw the same with GDX, GDXJ, and silver miners. They're all doing very similar price action. Newmont is, as you said, it's kind of that one in the indice that attracts those investors to move into it. When you look at the monthly chart, as you know, you can go way back here in time. It has been all over the place. Really, it hasn't even, it's a noisy chart. I'm not a fan of Newmont so much myself, just because it's getting up to nosebleed territory that it has been sold off, almost every time it gets up here, it sells off in a huge way. So money's definitely moving into it. I would almost call it a bit of a short-term contrarian play. When the masses move into it, usually that move is about done for that stock. So I don't like something that channels sideways like this in a 35-year channel. I'd rather get into something that has a strong movement, is near all-time highs, and hasn't been up at these levels and sold off. But there's no doubt Newmont has lots of volume. It's attracting the masses. People are getting excited about the precious metal space, and Newmont's definitely benefiting from it.
In contrast to equities fragility, the precious metals arena is glowing. Gold, silver, and especially mining equities have surged. Gold and silver are up over 25% year-to-date, while miners have jumped over 50%. Analysts highlight profound undervaluation and upside for mining stocks relative to bullion. Some see miners entering a breakout phase even as gold hovers near key thresholds like 3,065 to 3,378. The message is clear. While markets sway, hard assets may offer both shelter and lift.
That's a really good sign. It's got a very strong chart pattern. You could look at this in a few ways. It has this huge rally up. It has this big consolidation. It's trading at this 618 level, which if you remember, James, whenever something hits a 618 level and pauses, we almost always go up and see it hit the 100% measured move. So it's showing like it could go to about $154 to the upside. And that it's a very strong pattern. We've got this rally up. We got this giant, pennant formation where it's consolidating, and then it's broken out. It had a little pause, and, I wouldn't be surprised if we see it eventually continue to go higher. So I like something trading near all-time highs, leading the sector or the space versus Newmont, which anytime it gets up here, it just crushes your dreams and falls back down for another 5 years. So you definitely want to pick the leaders, and in the high momentum plays, they're the ones that benefit the most. There's all kinds of studies that show if you're in the leading high momentum plays in the long run, you'll outperform most other strategies. And so this one's definitely leading the way.
We stand poised at the tipping point. Serious warning signs abound, yet underlying strength persists. History and current data both hint at a looming pullback, yet earnest bullish forces remain. Is this the setup for a melt-up propelled by the AI narrative, or the onset of a deeper correction as breadth fades and volatility creeps in? Patience, clarity of rules, and readiness trump bravado. Whether you sit in cash or gold, hold or pivot, you must be prepared. The path ahead demands measured action, disciplined timing, and a willingness to adapt.
Yeah, so if we take a look at silver, it has both gold and silver are down today. We're seeing money kind of trying to figure out what it wants to do, but silver's been working its way in this uptrend. It's a pretty ugly chart in the grand scheme of things. Silver's, obviously more volatile than gold, but it is channeling. It is in an uptrend. It's just noisier. Anybody who trades it, you just have to, that's part of the game. You just have to digest those movements, and it's holding. It's bounced off the 50-day moving average. It's moving up. I think if we see gold break out to the upside, I think we're going to continue to see silver run and push higher. I think the next stop for silver is about 40.80. That's where that next little run could bring us, but it could obviously go a whole lot higher. as things unfold. But again, I think the precious metal space is in favor. I think, I like physical gold the best because it's got this most solid chart pattern. It looks like it has a nice explosive move. It's a global play, meaning the whole world, when it gets nervous, tend to move to gold. Silver and miners tend to be a little bit more of the speculative players, more North American driven. It's not showing like overall, global fear as much. So they can both work very well, but silver it's in the upper end of its range, and we just have to see how it goes. I'm not a big fan of this chart at the moment. I don't like how it's kind of had broken some lows here. It's volatile, but overall, if it continues to hold this move and consolidate through this range, it's going to build another launch pad to want to shoot higher and take a much bigger run.